I am Dr. Puvanendran, Assistant Professor, School of Commerce, KSR College of Arts and Science for Women, Tiruchengood. Now, we will discuss about the corporate accounting. What is corporate accounting? Corporate accounting is a specialized branch of accounting that deals specifically with the financial operations status and legal compliance of a company or corporation. In India, it is strictly governed by the Companies Act 2013 and Indian Accounting Standard. Unlike basic accounting for small shops or partnership, corporate accounting deals with large-scale transaction, public money, and complex financial reporting. Core objectives of corporate accounting: preparation of financial statement, creating the formal record of a company's financial activities strictly adhering to legal formations; capital management, accounting for the issue of shares, buybacks, debentures, bonds, and the payment of dividends of shareholders; consolidation of accounts. If a parent corporation owns smaller subsidiary companies, corporation accounting involves merge the all financial records into one master set of books. Consolidated financial statements like strategic analysis, helping management analyze financial performance, forecast, budget, and evaluate potential mergers or acquisitions. The key branches of accounting: financial accounting, managerial accounting, and tax accounting. The core purpose of financial accounting summarizes historical financial data using standard legal formats. External stakeholders like investors, bank, tax authorities. Managerial accounting provide cost analysis, forecasting, and operational budgets for decision making to internal management like CEOs, managers, and directors. Tax accounting, government and tax compliance officers. For the purpose, focus strictly on calculating tax liabilities and navigation internal taxes laws. What is share capital? The total money collected by company by issuing its shares is called share capital. The share capital like authorized capital, issued capital, subscribed capital, called up capital, paid up capital. What is a share? A share is a small unit of the total share capital of the company. Depending on the type, a share can offer the holder part ownership of the company along with voting rights. What is meant by the issue of share? Issue of shares is the process by which company allots its shares to investors willing to invest. Such an investor is called shareholders and can be an individual, corporate entity, LLP, private limited company or public limited company, and even an institution. An example of the issue of shares: ABC Limited is a company having a share capital of Rs 10 lakh, which is divided into 10,000 shares with a face value of 100 each. If anyone wishes to buy a stake in ABC Limited, they can purchase shares at Rs 100 each. Types of shares: equity shares and preference shares for ownership right, dividend rate, capital repayment on liquidations, voting rights, and convertibility risk. The three ways to issue of shares: issue of shares at par, issue of share at premium, issue of shares at discount. Issue of shares at par, like when shares are issued at a price exactly equal to the face value, like a nominal value. Issue of shares at the premium, when shares are issued at a price higher than their face value. This usually happens when a company has a great reputation and high market demand. Issue of shares at a discount, when shares are issued at a price lower than the face value. Pro rata allotment over subscription. When a company receives more shares applications than actually offered, the issue of oversubscribed. Instead of rejecting excess application completely, the company performs a pro rata allotment, meaning shares are allotted proportionally. Ratio like total shares of allotted divided by total shares applied. For accounting treatment, the excess application money received from investors is not refunded immediately. It is carried forward and adjusted against the money due during allotment stage. Forfeiture and reissue of shares. For futures, if a shareholder fails to pay allotment or call money, Within the specified notice period, the company legally cancels their membership and seizes the money already paid. Reissue. Forfeitures shares are usually resold to new investors. Unlike regular shares issues, forfeited shares can be reissued at a discount, provided the discount amount does not exceed the money already confisced in the share forfeited account. Rights issue. Section 62 of the Company Act 2013. When an existing public company wants to raise fresh capital by using more shares, it cannot directly sell them to outside. It must first offer these new shares to existing shareholders in proportion to the current holding. This is now as a rights issue. Why do companies issue right shares? To protect the control voting power of existing shareholders from being new investors. It is a cheaper way to raise capital since it avoids massive underwriting and public advertisement expenses. Shares are usually offered at a price lower than the current market price as a privilege to loyal investors. Shareholders' options exercise their right, re-announce the right, ignore the right. Bonus shares. Section 63 of the Companies Act 2013. Bonus shares are additionally completely free shares given to existing shareholders in proportion to their current holding. Permissible sources for issue bonus shares: free reserves, securities premium account, capital redemptions reserve. What is underwriting? Underwriting is an insurance-like agreement between a company and a financial institution. The underwriter guarantees that they will subscribe to the remaining shares or debentures if the general public fails to fully buy the issue. Types of underwriting agreement: pure underwriting, it's like a conditional; firm underwriting; full versus partly underwriting. What is underwriting commission? When company issues shares or debentures to the public, there is a risk that the public will not buy enough of them. Underwriters take a financial risk guarantees by any unsold shares. In return for this service and risk bearing, the company pays them a fees known as the underwriting commission. Legal rules and statutory maximum limits. The payment of the commission is strictly regulated under Section 40, the Companies Act 2013. As a future accountant, remember these key legal boundaries: articles of association, sources of payment, strict statutory caps. Thank you.